Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. I'm your host, Joe Mosier. Mergers and acquisitions, as you know, are an act of strategy execution. When they're properly aligned to your strategy, when you scope them in a manner that's consistent with the capacity of your company to execute, when you've targeted them at the right sector, the right segment, the right organizations, they can meaningfully accelerate the evolution of your company. They can dramatically improve the speed at which you move from the agribusiness that you currently are to the agribusiness that you wish to become. There's no doubt. But they don't exist separate from the wider economic and competitive conditions in which you operate. All sort of external factors come to bear upon M&A opportunities and the success thereof. External factors affect the costs associated with an acquisition. They can affect the number of suitable targets and options that are available to you. Sort of what's the sell side look like, who's willing to exit, who needs to exit. And they even will affect the response that you can expect from your customers, from your competitors, and from the market writ large. And so this week, I'm really excited to share my conversation with Scott Porter of Cascadia Capital. Scott's a managing director at Cascadia, and they're a middle market investment bank that serves private and public companies with M&A, capital raises, corporate finance, and strategic advisory services. And as a member of the firm's food, beverage, and agribusiness team, Scott leads Cascadia's agribusiness practice, focusing on companies in production ag like growers, packers, and shippers, ag inputs, both chem and straight inputs, fertilizer, etc., seed and genetics, food processing in the ingredients and primary processor space, and even in the ag tech sectors. Now, our conversation is timely because there's so much happening in the news, and we're sort of seeing this shift in the market. But as a preview, our conversation is going to cover what Scott sees in the M&A market today, what he anticipates as we go not just into Q4 of 2025, but also into the next couple of years, 2026 and 2027 as well. We're going to talk about trends in co-op consolidation, what's driving that, who's likely to benefit and who may be under threat and risk. We'll talk about PE or private equity's continued activity within agribusiness. And we're even going to close out with some thoughts around one of the largest deals to close in agribusiness in the last couple of years. You know, this show is about inviting and amplifying and aggregating perspectives, all to help improve our shared thinking around strategy execution in ag. And it's a real pleasure to have Scott's voice be a part of that corpus of collective intelligence that we're working so hard every week to build. And so I want to say thank you for taking the time to tune in today, and thank you for being a part of the Pacesetter Pod community. With that, let's jump right over to my conversation with Scott Porter of Cascadia Capital. Scott, good to see you. Welcome to the Pacesetter Pod.
Thank you, Joe. Appreciate you having me on.
You bet. We're sitting here talking about the transition into fall and kids getting back to school, and we could probably do an entire episode around how the first few weeks have been, but let's not punish our guests with that. Scott, you are a member of Cascadia Capital. We got a lot we want to talk about today related to M&A and agribusiness. But before we do that, talk to us a little bit about Cascadia, who you all are, what you do, and your role within the firm.
Yeah, appreciate it, Joe. So Cascadia at its core is an investment bank. What does that mean? At the root of it, we work with entrepreneurs, business owners, privately held companies, multi-generational family businesses to really do two things primarily. We advise on mergers and acquisitions advisory. So we help companies sell themselves. On the flip side, we help companies make acquisitions. The second thing that we do is what we call capital markets, which really is debt and equity raises. So we help companies think about their balance sheet. We help them raise capital, both debt from lenders, either traditional lenders or non-traditional lenders, as well as equity from financial investors, family offices, private equity funds, and things like that. It's not every day that an entrepreneur and business owner is looking to sell, looking to acquire, or looking to raise capital. They're just not everyday types of services. And so The majority of my job is trying to bring market intel, market advice, and ideas around what's happening in the market to help arm business owners with the tools and data points to make the best decision for their business. I personally help lead our firm's food and ag practice with a specific focus on the agribusiness sector. I grew up in a small farming town, married the daughter of a fifth generation farming family, and have been in and around ag my entire career and the center of ag and finance. So that's what I do at its core.
Very good. And is there within that, because Cascadia is a pretty big profile entity and you guys have advised on some pretty significant headline transactions within the agribusiness space, but give us a sense of what is the typical profile of a buy or sell side agribusiness client, meaning by either enterprise value, ownership structure. Do you guys work with co-ops? Things of that nature would be helpful, I think, for our guests as well.
Yeah, good question. I appreciate it. So when we think about our agribusiness practice, it really covers 4 areas. The first is agricultural inputs. So think seeds, genetics, traits, crop nutrition, crop protection. We've done work with the ag retailers and dealers and distributors, the big OEMs as well. The second area that we spend time in is production agriculture, both in permanent and specialty crops as well as row crops. So the producers themselves, and that's not just across crops, but also across animals, poultry and eggs, dairy and cattle. The third area that we spend quite a bit of time is the specialty and value-added processing, grinding, milling, blending, packers, shippers, all of that. And then the last area is ag tech. So all of our work across agribusiness is generally with companies across one of those 4 segments, which comprises the majority of the market. From an enterprise value perspective, I would say we're generally working with companies that are on the low end of enterprise value, 50 to 75 million, all the way up to a few billion. To your latter question, we do a lot of work with co-ops, and we could talk about it a bit later. We're seeing just a tremendous amount of co-op activity in the mergers and acquisitions market right now. So that's a big area of what we do beyond working with a private family-held business.
Very good. Well, thank you for that. And we'll definitely drill into that co-op space specifically. We don't advise exclusively co-ops in our practice, and this show is not exclusively for co-op management and owners, member owners, but that is a significant portion of the market. And so I think it'll be helpful to dig into that. But before we do that, the first question, of course, for someone, you said you provide market intelligence, data, and insights and observations to owners. So the first question is obviously going to be like, where's the market at? But as we're sitting here in Q4 of 2025 and looking into the next year or two, what are you seeing broadly in agribusiness around, appetite for transactions, volume of transactions versus trend? And then we'll kind of go from there.
Yeah, absolutely. So when I think about the M&A market, as well as the ag markets, the farmer health, retailer health, input company health, in my opinion, it all stems first and foremost from one thing: net farm income. And so net farm income is something that we track very closely because I personally believe it's the single most impactful driver of market conditions and therefore has an impact on mergers and acquisitions. This is a really unique time. This is what I would argue is the first time in my career where net farm income has been depressed across a majority of the commodities throughout the majority of the regions in the United States. So in Midwest row crops, think corn and soy. Net farm income is depressed. In West Coast, East Coast, permanent specialty crops like tree fruit, tree nuts, table grapes, blueberries, net farm income is depressed. Typically, we'll see certain commodities in a year have some challenges. This is a time that I think is really unique where we're seeing depression across net farm income across pretty much every commodity. Did you see the Wall Street Journal article that was published a few days ago? It did a really nice job summarizing some of the net farm income challenges. It was called "The Corn and Soybeans Rule the American Farm, Why That's a Growing Problem in Charts." Did you by chance see this?
No, I did not see that, no.
Okay. For those listeners that haven't read that article, I'd encourage everyone to go take a read. It does just a phenomenal job, particularly with charts and supporting it with data, with addressing some of the challenges we're seeing with net farm income. I think, though, at the root of it, it's due to a few dynamics. The first is I believe we have a massive supply-demand imbalance, and that's across a lot of commodities. I think you can attribute that to three things, certainly more, but there are three big drivers in my opinion. One is we've had over the years significant advances in technology that are driving efficiencies, whether it's at the seed level or the farming level. As an example, in 1995, as this article points out, in 1995, the average bushel per acre for corn was 114 bushels per acre versus 189 today.
Yeah.
In soy, it points out that it was about 35 bushels per acre in 95 and is 54 today. And so there's just a reality that we're producing more with less, and it's driving up supply. The second thing that I think is really driving this supply-demand imbalance, and this is a personal thesis, but I don't think we've ever quite seen what almost 15 years of free money can do to a capital-intensive industry. And so when you think about the last 15 years of peak ZIRP, zero interest rate policy era, what we saw was a lot of money and liquidity in the system, and farmers utilized that excess capital to go and buy more acres and to grow in a plant. And so specifically within corn acres, we've seen a 36% increase in acreage since 1995. In soybean acreage, we've seen a 29% increase since 1995. And so it's created, all of this capital coming in has helped create the supply-demand imbalance. And then the third issue that a lot of people talk about right now is the trade policies, tariffs, but I more so think about and put it as the globalization of ag commodities. Brazil being a good case in point that has in recent years dramatically outpaced the US and global soybean exports. And so our relevance to the export market, both because of trade policies, but just generally because of the globalization of global agriculture, has created this dynamic where our supply-demand imbalance across many commodities is out of whack. And that, I think, then sets the stage for M&A. But not sure if you would agree with that, if you have any other thoughts to it.
Well, no, I think it's a good encapsulation of where we're at. And I hadn't thought of the idea of 15 years of ZIRP or free money and how that echoes now through the industry. So that's what I need to chew on here a little bit. What I find interesting about the global nature of both the supply and the demand, but let's play at the supply side for a moment, is we recently had Jim Sutter on from the U.S. Soybean Export Council, and he had talked about how the booming nature of Brazilian soybean production, their forecasted production in this coming harvest cycle, or this year rather, will be at pure parity with Chinese demand. And so how they are largely growing concurrent with Chinese demand, and that how every year we tend to have equalization of supply and demand in the aggregate. And so we actually globally are probably not grossly overproducing our demand signal.
Yep.
But it's almost a timing and distribution challenge. And when you lose China as a primary export demand market for many of the soybeans, for example, in this case, when you lose some of that demand, it does distort the commodity values and drives them down, even though there is that aggregate demand can be recreated elsewhere.
Yeah.
It's just a heck of a lot harder to actually manage that inefficient supply chain to get it to smaller ports, smaller countries, smaller consumptive markets than it is when you have this giant machine you're trying to feed. So I don't disagree. When you kind of look underneath the hood then of those headline factors of a somewhat depressed marketplace, would you expect, or are you seeing that shows up as distress in people's performance and balance sheets, which then drives them to look towards an exit and actually creates a market for businesses to transact? Or are we still in this hunkering down moment where people are trying to weather the storm and not sell on the point of distress?
Good question. It's a bit of both, but what I've seen in my experience is markets like this, which create volatility, generally create uncertainty and challenges, and therefore more M&A. And in a market of M&A driven by volatility and challenges, you have a dynamic where winners and losers are created. So in the same way where you said global supply may have parity, supply demand isn't created equal. We may have parity in one region or undersupply in one region, oversupply in another, maybe on a global basis, there's parity. The same is true in M&A with companies. You may have a challenged marketplace, but some of those companies may be doing really well because of that volatility. They're taking advantage of opportunities that have come. Others are not. And so as an example, we are working with a company, I'll hold off on sharing the name, but we're working with a company that supplies a lot of micronutrients and biostimulants to row crop farmers. They have seen a tremendous amount of success in this market. Their competitor down the street has not. And so they're taking market share in the midst of market volatility at the expense of those that are underperforming in the market. And that in and of itself creates consolidation in the market. We have a thesis here at Cascadia that the best companies are made in the downturns. And the reason is the challenges creating volatility, creating uncertainty, and then creating consolidation allows good companies or the winners to go out and opportunistically make acquisitions and come out of that downturn much stronger than they otherwise were before that downturn. And so it's a really important time of the M&A markets where winners and losers are being created. And it's also, secondly, to your question, a nuanced market. What is true of one company because there are winners and losers is not true of another. So I'll have a company ask me what I think they're worth. I may give them a very different answer than their competitor down the street because it's a very nuanced market relative to what we used to have.
And what drives that nuance? So there's clearly something that you're seeing beyond the asset listings and the IP that they own and the trailing 12, 24, 36 month in financials. There's clearly something else you're seeing, or I presume there is, that gives you these wildly different valuations. In terms of endogenous factors within the four walls of their business, what are companies that are getting a higher suggested value? Mm-hmm. What are they demonstrating to you versus those that maybe are getting a number that they're less thrilled about?
Yeah. The first part of that answer is a bit soft, so I apologize in advance. But the soft part of that answer is it comes down to the people. I had one private equity investor suggest to me one time, he said, I've invested across every industry in our global GDP that you can think of. In agribusiness, it's the one industry that I think is most dependent on people and great operators. And the difference between a good operator and a bad operator has significant implications on what you see in the financials and the level of responsiveness they have in challenging times. And so I do think that a big part of it comes down to the people that are within that organization and how they're responding to market volatility. The second thing, and there are many, but the second thing I'll touch on here that I've seen drive winners and losers in volatile markets is a healthy balance sheet. Those companies that have a balance sheet to take advantage of opportunities generally become winners. Those companies that have distressed balance sheets and are unable to take advantage of opportunities that emerge in downturns or are too busy being focused on dealing with their bank or managing cash flow from a week-to-week basis tend to struggle in the downturns. A strong balance sheet can cover up a lot of issues or a lot of challenges that emerge in challenging environments.
Yeah, that makes sense. The one thing that's coming to mind here, and I'd be curious to get your thoughts to the extent that you can share them without violating the trust of your clients and prospects and folks that you work with. But so for folks that go into a downturn that have good agile operators in place that can take advantage of opportunities, that can respond to the conditions on the field, buttressed then with a strong balance sheet. So one of these, the classic company that's well positioned to take advantage, as you just outlined it. And their competitor maybe either lacks some of those people attributes or some of those balance sheet attributes, or maybe a mix of both, and they're suddenly in distress, et cetera. The concern I always have, because we see this sometimes in the integration phase, is that this company that was well positioned to take advantage of an opportunity hadn't actually envisioned of M&A as a vehicle for growth. And so they're confronted with a compelling opportunity in front of them, but it actually wasn't part of their pre-existing, predefined strategy. And so sometimes the attractiveness of the value at the moment that it was available is what drove the deal seemingly, versus actually saying this is the profile of a company that we would want to own. We believe we should own. We have a thesis around how to own it and run it. And now it's presented itself. Do you all see that in this context, or is that something that's part of your process? You sort of stress test up front to make sure you're not having folks take advantage of an opportunity that maybe is not really in alignment with their long-term growth strategy?
Yeah. So I heard a couple things there. I think first and foremost, getting bigger in M&A for the sake of getting bigger in M&A is not a strategy and not one that I've seen work in my career. So M&A for the sake of M&A or opportunities for the sake of opportunities are not good. Good business owners must assess, is this the direction I want to go operationally? Does this align with my vision for success within the market context and the market paradigm? But the second point that you mentioned is that doesn't mean that an M&A opportunity that you weren't contemplating coming your way is not a good opportunity. It must align with the vision. And that is where, in my opinion, strong balance sheets are exceptionally valuable, because a lot of M&A comes at unpredictable times. My experience with business owners is they are not sellers until one day they wake up and they are. And so it's very hard to predict when a great M&A opportunity may come. Having a strong balance sheet to take advantage of those opportunities that come at unpredictable times is what separates business owners from being able to take advantage of those good opportunities when they come versus others that aren't able to, they don't have the balance sheet to take advantage of that opportunity. So I think it's twofold to answer your question.
Yeah, that makes sense. And I just think that the message I also want to make sure we drive to the folks out there that are actually saying, hey, look, we're frankly doing not just better than our neighbors, but we're doing better than we would have expected. And we're actually pretty comfortable with our performance right now. And opportunism is not inherently bad in the context of M&A, but you do need to be clear-eyed and honest with yourself and say, okay, does this deal, is it actually anchored in driving maybe the outcomes that we want for our company? Maybe it's a different avenue to get there, but is it additive to our destination? And so kind of coupling that strong balance sheet with predefined vision for the future creates healthy opportunism as opposed to maybe destructive, almost reckless. This thing is for sale. We'd be stupid not to buy it. It's trading for pennies on the dollar.
That's
and
right.
And then 2 years later saying, man, we could afford to own it. Doesn't mean we should have bought it.
Yeah, that's right. That's right. I had one executive at one of the major seed companies share an interesting perspective that he had. And sorry for this tangent, but he said, what I found in my career, and he's very experienced. He said, what I found in my career is in periods of change, status quo is often the riskiest option or one of the riskiest options. And he said, status quo doesn't mean that you go and make big changes, but status quo means if you're succeeding, you don't rely on what you've done, just what you've done to succeed. You're constantly pressure testing the changes in the market and how you need to adapt to it. And that is applicable for M&A as well as just strategy and overall operations. But I thought it was an interesting point that he viewed very strongly. Status quo is risky in changing markets.
Yeah. We had Jim Schweigert of Grow Alliance on probably a year or two ago on the show, and he has a very strong perspective on a similar topic related to, needing to appreciate status quo risk, because at, kind of a spin on what you just said is it often seems like the safest avenue is to continue doing what you're doing. And it might be, but it doesn't mean it's without risk. And so understanding and appropriately weighting status quo risk in the context of these decisions is incredibly important. That's incredibly helpful to kind of level set on where you're seeing the market now. And obviously a lot of these macro factors of, just the echoing nature of 15 years of free money and a persistent up and to the right, trend line yield performance and improvement across global commodities and uncertain trade policies. And, we'd even talk about population growth or slow growth or no growth. There's a lot of things that are maybe not going to change overnight, but let's look specifically within agribusiness, within the U.S. context. What are you seeing or anticipating certainly since Q4 of this year, but more importantly, maybe through calendar year 26, 27. Are you expecting that this distress coupled with expectations around lower interest rates will spur more activity, less activity? What else would need to happen to sort of accelerate or decelerate the M&A market and agribusiness?
Yeah, I expect that it will lead to more activity and more consolidation, which will be both necessary consolidation for those that are distressed, and then those that have the balance sheets, opportunistic consolidation. So we believe that the markets are going to pick up in a big way within the agribusiness sector. We can talk about in a bit, Joe, some of what we're seeing in the private equity and financial markets, but that is also a big driver of some of the consolidation trends that we're seeing within the markets. If I had the ability to crystal ball the next couple of years, I'd be a lot wealthier than I am. So I don't claim to know exactly what will happen. Most of my views come from getting to speak with a lot of intelligent individuals and local boots on the ground, and kind of combining a lot of views that I've heard. But over the last year, as my team has met with 1,000 different operators and farmers, I think the general consensus is that this year or the next farming season will probably see the bottoming out, and we'll start seeing gradual improvements to net farm income and to the market overall. That being said, when that happens, two interesting things occur. On one hand, you have improving markets and improving financials. On another hand, you have more distressed companies in the system. So I'll give you an example, and bear with me because it's not the best example, but it's a very relevant and recent example. If you look at the California almond market, and I use that example because it's the most recent one that I can think of. The California almond market has improved this year from a commodity pricing perspective versus where it's been over the last 3 or 4 years. But this is probably the most distressed year that the industry has had with many producers in a very long time. The reason being is multiple years of challenges can create enough distress that after a period of time, sales and bankruptcies and liquidations and consolidation has to emerge. So the way I think about it is the first year, you have a net loss on the farm, your balance sheets can eat it, no problem, it's fine, it's agriculture, it's farming, it happens. The second year, it happens, your balance sheets eat it, but it's a little more painful. The third year, it happens again, and now there's meaningful distress in the system. You start tripping covenants, you start having to have difficult conversations with your lenders, and then that fourth year is when they really start forcing consolidation. And so in the almond industry, we started seeing a lot of consolidation forced by lenders who were unwilling to extend additional capital to companies that did not have the operating liquidity to get through the next season. So I think my crystal ball is over the next couple of years, we're going to see commodity prices gradually improve. We're going to see net farm income gradually improve, but we will see an increase in distressed sales and M&A because of the depleted balance sheets that have occurred over the last few years.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
You kind of maybe answered my next question as I was thinking as you were talking there. This is anecdotal, so I don't have data to support this, but I think about when we came off of the froth of 21 and 22.
Yeah.
And, everyone talks about being kind of hyper-concentrated in ag tech, but you saw it in a lot of different places, and businesses transacting, and folks had a lot of money to deploy and invest in their businesses and invest in acquisitions. And then deal volume, and to some extent deal value, kind of went down pretty significantly.
Yeah.
We didn't see, in some of the conversations that we're a part of, we didn't see a lack of appetite for deals. We saw a lot of daylight between seller expectations, watching their legacy competitors who traded in 21, 22 at a price that probably was divorced from the market. we saw a daylight between what their expectations were and what the buy side of the table was willing to spend. And that was my question is, as we go into this, if next year is actually the trough in terms of commodity values, net farm income, and it starts to rebound, are we at a point now where those multiple years of distress, the long tail of distress, actually removes the luxury of a seller saying, I'm going to wait because I think my business is worth more, and they're actually forced to liquidate? Or do you still see that we're going to probably have that persistent sort of disconnect between what an exiting owner believes their business is worth and what the market is willing to pay for it?
Great question. We will see, in my opinion, a bit of both, but more distressed, forced liquidations than what we historically have seen. So business owners, companies that have been holding out for market improvement will get to the point where they're either tired or forced to do something. Taking a quick step back, I kind of think about the market over the last 20 years across 4 eras. You have what I think of as the recondite era. So think of that as esoteric, obscure, overlooked. Ag as an M&A opportunity set, particularly for financial investors, was not really well thought of, not often thought of. And so there was very little M&A. Think of the period of early 2000s to 2010. M&A in agriculture was largely driven by a few strategics that were growing and very little else. This would have been in 2013, you had the Climate Corporation sell to Monsanto for over $1 billion. That was a big investor success story where investors came in to the Climate Corporation, built a business under Dave Freeberg, and sold it to Monsanto. That drew a lot of attention to the market opportunity within agribusiness overall. And I view this era I call this era the rational exuberance era. There became a lot of excitement about M&A in agriculture. Think of this as the 2013, 2014 era to 2019. We saw year after year of growth in M&A and interest in agriculture. This aligned with some nice increases in net farm income, and it was a really nice period of strong growth, but aligned value expectations from a seller perspective and from a buyer perspective. That third era is what I think of as the reckless exuberance era. So not rational exuberance, but reckless exuberance. This is when we were at peak liquidity in the markets. Valuations were skyrocketing. Seller expectations became exceptionally high. And buyers were doing things that frankly, today they look back and say, yeah, that probably wasn't a wise investment or a smart investment. And as a result of all that, and then came rising interest rates and challenges in net farm income, we had the bubble burst. And this current period that we've been in, I call the reality check era, 2023 to 2024, where you have exactly what you said, a big mismatch in seller expectations relative to what buyers are willing to pay, because that bubble burst and net farm income became more challenged. The valuations buyers were willing to ascribe to companies came down, but seller expectations on average did not come down. So this next era that I've been talking about, I think, is going to be the retrench or reckoning era, which is the winners and losers era. Those that are winners, I think, generally will find good opportunities for M&A. Those that are not the winners or have not been as successful, they need to either retrench or rethink their value expectations, or they're not going to be able to do anything in this market.
It's an interesting way to structure it over the time horizons. And I also think about a specific conversation we had whereby a seller, this would have been in your reckless exuberance era.
Yeah. Mm-hmm.
A seller, and this was via an independent third party that was also working in the transaction. The seller was motivated to time their exit in response to the rising cost of capital and the borrowing cost to run the business, and saying, look, this is going to be what makes this just very difficult, and I don't have enough fuel in the tank anymore. I've been doing this for 30 years. Someone else needs to own this business. So that was a driving factor.
Yep.
Conversely, it was that exact same set of conditions that was driving a serious discount imputed by the buyer's calculation, the buyer's advice to say, look, the cost of capital, what we're going to need to do to invest in this business, the lines that we're going to have to extend in order to just capitalize the business and keep it going and finance inventory and finance sales are such that there's going to be a discounted value offer. And it was actually the same thing that was causing that disconnect. And frankly, largely because I think the seller couldn't imagine why, the buyer having to deal with those conditions. And so that's why I keep coming back to this expectation now of significant rate cuts continuing throughout the end of the year. I do think also adds a bit of fuel to this as well.
It does. Yeah, I agree with that.
So we talked at the top about co-ops, and now we've kind of set the stage with where the market's at today, where it's been in terms of the different eras that you watch us through and what to expect in the next couple of years. Co-ops are a bit of a different animal, trading equity, not dollars necessarily at points of transaction. But we directly and indirectly are involved in a number of different conversations and different boards that are exploring whether a merger makes sense for them, generally, whether a given merger is in the best interest of their member owners, trying to conceive of how to execute certain mergers operationally, following presumptive support from voting members. But I can't speak to necessarily the pace or volume that we're under and what is to come. As you all work with co-ops, how do you see all these different conditions we've talked about playing out within the co-op complex in the U.S. in terms of deal appetite, deal volume, deal size? And the size in that case really is the size of the entities involved.
Yeah. I think of the co-op space as everything we just discussed from a market condition perspective, but on steroids. When you look at the number of co-ops that we had in the U.S. in 2000, it was about 3,300 co-ops in the U.S. in the 2000s. In 2023, which is the last number I had offhand, there were just about 1,600 co-ops. So there was a reduction of over 50% of our co-ops from 2000 to 2023. A large part of that was due to some large mergers. To name a few this year, there was Arla Foods and DMK in the dairy co-op merger space. There was Northwest Grain Growers with Mid-Columbia. Last year, you had West Central Ag Services and CHS. And then you also had a number of bankruptcies over the last few years, but it's largely due to mergers among co-ops and bankruptcies that are driving the significant reduction over the last couple of decades. I personally bucket, and this may not be the best way to look at it. It is admittedly a bit black and white, but I bucket the co-op space into two categories or two types of co-ops. Those that run the co-op like a corporate institution with strong governance standards and independence, or some level of independence from the members. Some will disagree with these names, but I think of CHS, DFA, Land O'Lakes, Ocean Spray, all very well-run co-ops that do great things for their members and member owners, but at the same time have strong governance, corporate governance, and independence. That's one type. And then there's the other type, or everyone else, that, in my opinion, tend to run the co-op for the sole purpose of serving the farmer, which is good and why co-ops exist. But sometimes serving the farmer member means that you have to do things that are for the benefit of the co-op in some years and not for the benefit of the farmer. Sometimes that alignment of interest does not exist. And I think of a recent, very public bankruptcy in the co-op space, a company called Norpac, which was the frozen vegetable space. You had a dynamic there where demand for frozen vegetables was declining, but the co-op members wanted the co-op to continue to purchase their crops, their inventory, even in the midst of declining volume. And so they got upside down from an inventory perspective, created a very challenged balance sheet, and ultimately forced consolidation. And that, I think, underpins the market that we've been seeing in the co-op space, where you have a lot of bad balance sheets, you have a lot of challenged co-ops that are in need of doing something. And that's where we've been getting involved, helping them understand what are your options outside of status quo to address some of these issues.
Yeah, as much as and you sort of prefaced that with saying this is an imperfect bifurcation of the market, and it's very binary. You're either proper corporate governance or you're everybody else. And, we have the benefit of actually probably working with the exceptions to that second rule and the folks that are smaller local co-ops that, of course, are working in the best interest of their growers, but are taking a long-term view on that and saying, if we're not around in 15 years to support our growers, then are we really supporting our growers? Now, admittedly, there's a lot of selection bias in that because we're working with the folks that have actually recognized the need to think strategically about merger and consolidation and actually try to pressure check their readiness in advance of executing it. That's a small subset of the complex that actually say we should probably look in the mirror and get an honest reckoning or honest assessment of our capacity to execute. So I do think that there are a number of teams out there, in part or in whole, that are aspirationally moving towards that first category or are almost there.
That's right.
But probably aren't headline institutions.
That's right.
In terms of the scope of Land Lakes and CHS, but not necessarily taking issue with the classification. I do think it's true in the broadest expanse.
Yeah, and to be clear on that, I use those names only because they're no names, but I think I see that distinction among some of the smallest. There are some of the smallest co-ops that have phenomenal independence and governance and think, like you said, in long-term increments for the benefit of their members. The distinction is less on size and name and more on, are you taking that long-term approach or not?
Yeah, and mindset and perspective. Yeah.
Yeah.
One of the things that, as a brief aside here, that I and many, many others for many years have observed, people, it's very easy for folks to sort of bemoan the challenge of somewhere between 10 and 25 farmers coming in monthly or quarterly to sit as directors in a co-op board meeting, and everyone's saying, well, you need to take your farmer hat off and put on your board member hat.
Yeah.
As if that farmer hat is somehow a liability. And it can be if suddenly the decisions that you take are evaluated solely through what's the micro impact to my operation. Mm-hmm. But it actually is a real strength to have everybody sitting around those tables be an owner, a participant, and presumably a customer of the co-op that's being discussed. And so it is a matter of, have you equipped that board to understand what good governance looks like? Have you invested in them to actually give them the tools, the frameworks, the skills, and the time to level up to be good directors? And so I always sort of cringe a bit when folks sort of dismiss a board that's making suboptimal decisions or seemingly suboptimal decisions solely because they're a bunch of farmers. And I'm saying, well, there are a bunch of farmers who also sit on the board, and we have an obligation for helping equip these folks to apply their incredible entrepreneurial spirit, can-do attitude, resourcefulness, just apply it in a different way. But I'll get off my soapbox there, Scott.
Oh, that's good. I agree.
We're getting closer to time here. You mentioned earlier on that private equity also has an interest in agribusiness. So maybe moving off of co-ops for the moment, what are your observations again around pace and volume of PE activity in the space? And are there specific legs of the ag value chain that you see them more or less interested in, both recently and in maybe the next couple of years ahead?
Yeah. So based on our data, we were averaging about 100 deals a year back in 2010 into the ag space. Today, it's about 300 deals. So it's about tripled from 2010 to 2025 in terms of the number of ag deals a year.
By private equity.
By private equity. And when I think about the dynamics driving that, private equity looks at a lot of the dynamics you and your listeners are well aware of, right? You have a market that's feeding the world's 8.2 billion people. It represents 4% of global GDP. Creates a lot of jobs, I think represents about 28% of the world's working population. It drives global trade, is about 8% of our world's global trade. So it's a very integral part of the GDP and economy, yet at the same time, it historically has only represented approximately 2% of global M&A. And so I think many private equity funds have taken this view of the significance of agriculture is much greater than the level of M&A we've had historically. And therefore, that should represent opportunity for us. Investors have also liked that ag tends to act as a good diversification play relative to other investments they've historically been invested in. It can act as an inflation hedge, or historically has, at least on the land side, and often has been counter-cyclical relative to the broader economy. And so private equity has been attracted to a lot of that. I personally believe there's one big driving factor on top of all that right now, which is private equity has a lot of capital that needs to be put to work. 2020, 2021, 2022, those were all very big years for new fundraises and new capital raised by private equity. And we are sitting at one of the highest periods ever of what we call private equity dry powder, which is effectively capital raised that still needs to be deployed. We're at over $1 trillion of private equity, mid-market private equity money that needs to be deployed. And that's up from 300-ish billion back in 2014. So there's a lot of capital chasing fewer opportunities. So going back to that supply-demand imbalance, it's a bit of the inverse right now from an M&A perspective. There's a lot of capital chasing fewer good companies. And so when good companies in the ag space come to market, there's a tremendous amount of interest from private equity.
And to what extent, from your experience in your seat, have you seen some of the individual deal thesis around, I don't want to paint PE too broad of a brush. I think it's unfair to the industry and it's not reflective of reality. But there's some that see value creation or extraction through roll-ups and getting scale and standardizing some back office processes, some through rationalizing physical assets and distribution networks and sort of like reducing touch of inventory.
Right.
Sometimes it's a personnel play, and sometimes it's just looking at a business and saying, there's more margin to be captured in this business because there's fat to be cut. And in my experience, in many of the front end ag supply chain entities that I've worked with and for, they're fairly lean, driven by the fact that there's not a lot of margin there to begin with. So it's almost a forced,
that's right,
a forced austerity in how they choose to staff and operate their business. So ag tech aside, which is a whole different profile,
right?
Do you think that it's truly as promising for private equity as maybe some of the things that create the gravitational pull for them to come into it? Is it really stand up to scrutiny?
I'm going to generalize a bit, so forgive me for this. I think on average, in many cases, private equity that wasn't already in the industry did not fully appreciate over the last number of years the realities of the ups and downs and nuances of the ag market. That's a big generalization for a big market, but I do think there is some of that. When we say private equity, there are a variety of different types of investors. There are some private equity funds that are truly, purely food and ag focused, and in my opinion, understand the market innately. You can name a bunch of them, but there's Taze River, there's the Bill and Melinda Gates Foundation or investment vehicle. You have Arable Capital, you have Tiverton Capital, Summit Agriculture. There's a lot of food and ag focused funds that come from a farming background and are phenomenal investors to the sector. They get the nuances. There are generalist private equity funds that have gotten into the space. Some have done great diligence. I think others probably not so much. And that's where you've seen some of those challenges or maybe mismatches that you're speaking to. Those buckets, in my opinion, have been on average more interested in ag inputs and more midstream processors. It's another bucket of investors, family office and institutional funds, think pension funds and endowment funds, sovereign wealth funds that have been interested in production agriculture, actually owning the farm, owning the land. And I'd say that last bucket in many cases does have a very long-term approach to their investment thesis and is able to withstand the ups and downs of ag and that come with ag because of their long-term approach.
Yeah, and certainly I agree with that. I think some of the folks that you named, another one that comes to mind, of course, is Midwest Growth Partners that we've had on the show before.
Yeah.
Folks, they're in the industry, they're in the segment yes or yes, and they're in it for a reason. They tend to perform well. I've also seen some interesting activity from private equity / maybe almost like a family office structure that are geographically located close to where these industries reside.
Yes.
So they may be from the family office may have generated wealth in the back of a manufacturing business. And then they fund of course, are LPs in a fund that happens to be based in Indianapolis.
Yep.
Or in Des Moines, or
Yep.
in St. Louis, or in the Twin Cities, or in Omaha. And sometimes the proximity somehow creates a cultural alignment, I presume, or maybe they have access to the right advisors that'll help them look, at a specific opportunity. So they tend to do very well. One final question before I let you go, and I'll be honest here, I'm curious to see how you respond. I'm not entirely sure where this goes, but so we're also in this era where there's some pretty big transactions that have happened or will happen. And I'm thinking, we're at this time, we're still in the early days of the proposed Union Pacific, Norfolk Southern, UPNS sort of Class 1 railroad merger, which I'm not going to ask you to opine on that, but it hasn't happened yet. But I'm thinking about, what's the impact of our marketplace. But we had this year now, finally, the acquisition or the merger of Viterra. I guess it was Bunge acquiring Viterra and all of their grant assets. And Viterra had not that long ago just bought Gavilon, right? And Gavilon itself had been recently acquiring other operators. But so we have this big transaction, Bunge buying Viterra. There are, of course, some conditional elements to the approvals that they receive from regulatory authorities. But should we be looking at, if you're a small operator, hyper-local operator, the front end of the ag value chain, and you see these big deals happening, what are the ripple effects that you would see kind of cascading out throughout the industry, or what should smaller operators be thinking about when they see these large headline transactions? Is this a moment for panic, or a moment to think about opportunities, or just, and maybe that's too broad of a question, Scott, and it's not fair to ask, but I'm just curious to get your thoughts.
I appreciate that question, and it's the right one. It's a very meaningful and impactful transaction on the overall industry. I think it will lead to, for the small farmer, both challenges and opportunity. When markets tend to get too consolidated, in my opinion, particularly where there's opportunity, new competitors, new markets will emerge and open up. And I do believe that will bring opportunity. There's obviously, I'm sure you've heard, like me, there's been a lot of blowback on the transaction. I think Bunge's stock price fell 7% when it initially was announced. I know it's been heavily criticized by farmers who fear it's going to reduce competition in the markets. I believe all of that risk is there. At the same time, I'm going to take a bit of a counterpoint just for the sake of the argument. It's not necessarily that I believe it, but I'm going to take a bit of a counterpoint as far as why I don't view this as being fully catastrophic to the small farmer. I think first it's important to note that while the deal closed this year, it was approved in 2024 under the Biden administration. Why is that significant? I say this because, in my opinion, the Biden administration was widely viewed as having taken one of the most aggressive stances on antitrust enforcement in decades. The Biden administration appointed Lina Khan to chair the FTC, Jonathan Cantor to lead the DOJ antitrust division. Both were known for taking a very tough, very expansive view of antitrust law. And that is the backdrop of which this transaction was approved. And so I do take heart that there were the right eyes on this that viewed this from a lens of this does not create too much of a monopolistic market for the small farmer and for the consumer. What makes me believe that, I think it's important to look at, okay, let's go to the financials and the numbers of these companies. When you look at the ABCD companies, they average 6 to 7% gross margins, on average 3 to 4% EBITDA margins. Their CapEx each year is more than their net income. I actually believe that is as much of a byproduct, as much of a reason we're seeing consolidation in that space as anything. These are highly capital intensive industries with very low margins. When you look at the cash flow over the level of interest that Bunge has or ADM has, it's barely their cash flow barely covers their interest expense. I think Bunge, as an example, is at 1.2x their cash flow over interest expense. And so I look at that and say, that does not feel like 3 to 4% EBITDA margins does not feel yet like a monopolistic market. Will it have changes? Yes, but I think between the 4 ABCDs, there's still enough competition exemplified by the level of margin profile that they have that we're going to remain with competitive markets. I'm not suggesting there won't be changes that won't be good for the farmer, but I don't yet look at it and say this is going to be catastrophic.
That's a fair insight, a fair observation. And perhaps in your next time you join us here, we can dig into why companies with such thin margins and already a negative net income relative to CapEx are buying more to do more what they're already doing. Separate question. So we'll
Good question.
come back to that another time. But Scott, I really I appreciate your perspective and your thoughts on both what has happened and what is happening and what's likely to happen. And I appreciate you taking time to join us today.
Thank you for having me on. I appreciate what you do for the industry. I love listening to the pod, and thanks for having me on.
You bet. And we will make sure that we have in the show notes ways for you all to get in touch with Cascadia Capital and with Scott specifically as well to continue the conversation. Or if you're looking at a particular transaction or an exit or looking at M&A strategy and need someone to talk to, a great resource for you all. Thank you to everybody for tuning into today's episode. I am sure that you found something not just of interest, but of actionable value in our conversation today. And on the assumption that you did, I'm going to ask you to do one thing. Please consider sharing this episode with someone that you think would find similar benefit. It's the best way you can support the show and the best way to help us elevate thinking around strategy execution across the ag supply chain. I look forward to having you join us again next time right here on the Pacesetter Pod.
This is thepodcastfactory.com.